Welcome back to Vetted VA Live. If it's Tuesday, we are here with three of our vetted mortgage and real estate experts to talk about a topic of import that is coming up in the forums. And today we have an interesting one, a big one. It actually surprised me. Nathan and I were sitting around, not Nathan Einkorn, Nathan Nottingham. We were sitting around at an event a week or two ago, and it occurred to us we had never covered the topic of credit, and it's a very big topic. So if you saw the thumbnail on it, it's spooky credit reports in the theme of the season, but really talking about what you need to know about credit with your VA loan and using your VA mortgage benefit, what you can do to maximize it, what thresholds are important. So again, we've got three of our vetted experts here with us. Here on the top row with me is Brian Dix. Brian is with Global Mortgage Loans in Rancho Cucamonga. He is a VVA 5 and a U.S. Marine Corps veteran. Brian, anything else you want to add?
Yeah, if you're looking at buying your own place and you're thinking about getting chickens, absolutely do it. So chickens are one of the best investments you could ever get. So
I saw Nathan's picture the other week of him harvesting the eggs, and they looked like they had already been painted. I didn't know they came out any colors other than white and brown. Do your chickens actually deliver eggs that are pre-painted for Easter?
I wouldn't call them pre-painted, but yeah, it's actually a protein that gets deposited in the eggshell, and it's kind of interesting if you look. We have green, blue, white, brown, you name it. But if you look at a chicken's ears, they have this little ear skin thing, and most of the time, whatever color that is the color of the eggs they're gonna lay. So.
That's our fun fact for the day. Now, Nathan and Michael, you guys have something to live up to now. You also have to have a fun fact to go along like that. So also with us, Nathan Einkorn with Quick Start Mortgage Group with U Mortgage in Parker, Colorado, and Michael Wolf also with U Mortgage and Wolf Financial in Apex, North Carolina. So we got big swaths of the country covered. Any fun facts, Nathan, Michael, you want to add? Do you have colored egg-laying chickens, anything of that sort?
Check with your potential HOA on whether or not you are allowed to have chickens.
It's your God-given right.
Just get a couple roosters. Your neighbors will love it. So before we jump into credit, we're also at the end going to talk a little bit about the Service Member Civil Relief Act and some benefits that can protect your credit, help your credit, get you out of some credit situation. So we'll go through that as well. But for the most part, we're going to talk about your credit report, your credit score, and how that impacts your qualifying and terms for a VA mortgage. So with that, one of the things that people always want to start out and ask is, what's a good score, or what score do I need? Brian, you want to go through the VA's approach on that and what score is required and what is a good score for mortgage loans?
Yeah, sure. And I'm sure some of our longtime members are going to see some or hear some familiar words here, but the VA does not have a minimum credit score. So the VA does not care if you have a credit score at all or what your credit score is. What does happen is that certain banks will set limitations. They can take the VA's rules and they'll have their own more restrictive rules put on top of those, and we'll call those lender overlays. And most of the time what will happen is lender overlays will set scores at certain checkpoints. So we, being in the mortgage broker community, in certain banks can do certain stuff if they're direct lending. But in the mortgage broker community, it's great because there's usually access to different types of lenders. And there's some lenders, there's quite a few out there that will underwrite directly to the VA underwrite or the VA lenders handbook, the VA 26-7. So knowing that's great. But what does happen is even those lenders that they don't care what your score is, it has an impact on the pricing. So there's different pricing adjustments as far as what the mortgage rate is going to be. So, and different lenders will set those pricing tiers at certain checkpoints in the scores.
So Nathan, you had mentioned something earlier that's not necessarily common, but we do see occasionally. What are the important tiers generally when you're looking across your lenders and different rate sheets and trying to find the right home for a loan? What tiers of credit scores are important for getting improved pricing? And is there any benefit to having a massive score? Like on a conventional loan, we say, hey, 740 and above, you're going to hit that best tier. Is there anything equivalent on the VA side?
Well, typically, I mean, I think across the board, 680 is that number, right? When you're pricing out a loan, whether they have a 680 or a 760, they're going to be the same. But I think as the markets have changed, as the turmoil that we've seen today, for instance, I was pricing out some loans for a couple different clients. And and it's something that I always check, but at 680, this is where your pricing is going to be. But I went ahead and checked a couple other lenders at 720. And, once again, the benefit of being a broker is we have multiple lenders that we can work with. And so some lenders will update their pricing and their overlay on that specific, the VA purchase product. And today there was an 1/8 of a point improvement with a couple of our lenders for having a 720 FICO score or higher. And it goes across the board. When we talk about the minimums, like Brian had said, the VA technically doesn't, right? I mean, one, the VA doesn't loan you the money, so the VA doesn't say they don't care what the credit score is, but the lenders do. We have lenders historically. There are some lenders out there that'll do manual underwrites down to as low as 500. However, with the current market and the environment that we've seen, I really haven't seen, and this may be different for Michael or Brian, but I really haven't seen anybody going under 580.
Well, let's talk about that. You brought up a really important point. So we talked about pricing, and maybe a 640 gets you better than below that. 680 gets you to that best. You're having some lenders paying premiums for above 720. Besides just the pricing, how about the yes and no? Michael, how does that credit score come into play in terms of whether you're getting qualified, and what does it mean for automated underwriting?
Well, like you said, like anything below, 620, even 580 may not get the automated underwriting approval. And that would trigger a manual underwrite, right? And a manual underwrite in itself brings additional requirements, like, for example, two years of proving rental payments on time, lower income ratios, and that would be very restrictive for some borrowers, and that would be also come with lower income ratios and housing ratios as well. So that would be very restrictive. So even though it's possible, and some lenders will definitely go below 550, it's very restrictive, and they'll be restricted to very lower, a lot lower housing prices as well for their market.
So when you see that, if you have someone get kicks over to a manual, so let's just use an example. You've got a 580 credit score borrower and you got a 740 credit score borrower. Other things being equal, what maximum debt to income ratio is that 740 borrower likely to see through the automated underwriting system? And how does that compare for that 580 borrower having to go with a manual underwrite?
Well, 740, I've seen as high as 70% or higher on the income ratios, because it comes down to, for those borrowers who are stronger borrowers, higher credit scores and profiles, comes down to the residual income, right? So the residual, if that's strong right there, they're usually fine, right? But lower credit scores, the residual is a higher requirement as well. Depending on the debt to income ratio, it could be as high as 120% or of the minimum required, right? Compared to the 720 or anyone higher for automated underwriting. So it's a lot more restrictive for the lower credit scores and the higher credit scores for sure.
And I don't know about you guys, but I get this a lot of the time when you're talking to a person who's not a veteran or someone out there, and they hear what you're able to do debt to income wise on a VA loan. They say, oh, that's just a foreclosure waiting to happen. Oh, why would you loan to someone at a 60 or a 70% debt to income ratio? And you pointed out something really important, because we're talking about the topic of credit tonight. We don't want to put anyone to a bad situation. A foreclosure is one of the worst things that could happen on your credit record. So the VA doesn't want that. We as lenders don't want that. And you certainly don't want that as a borrower. But that residual income calculation is a really good alternate method for proving that someone has the ability to make a payment that other loan programs would have capped them out at a 45 or a 50% debt to income ratio. Brian, you want to explain real quickly what that looks like, what the residual income calculation is?
Yeah, so the debt to income ratio is just taken into, there's what we call a front end and a back end, and the front end is taking whatever we can use as qualifying income. That's not your total income. That could be more, your total income could be more than what we can use as what we call qualifying income. And with your housing payment. That's your front end ratio. And then the back end ratio on debt to income ratio is taking in all your other debt liabilities. So that's kind of that figure that they were talking about with going up that Michael said you've seen as high as over 70% on that back end ratio. Now residual income, what that's doing is that's taken into account for when we're using qualifying income. We're looking at your gross income, your pre-tax income, but the residual income, that's taking a look at factoring in taxes coming out, factoring in certain costs of maintaining utilities and things, and whatever you have left over remaining at the end of the month after all your bills are paid or anticipated bills on that residual income. Then the VA sets certain amounts in certain regions, actually, because home prices are different across the country. And they set that as a limit that must be, or a threshold that must be met for that. And as long as you're above that threshold, then that's an additional compensating factor that can be the difference of an approval or not. So,
and it's just an alternate method of making sure you're credit worthy. So hey, here's your total debt to income ratio is giving a little bit of a yellow flag, but that calculation says, hey, with your net income plus all your bills paid, there should be enough for a family to get by and be able to make that mortgage payment. So it's a cool feature that protects your credit. It's one of the reasons why VA loans have some of the lowest default rates of all mortgage programs. So we've kind of established what credit scores you need, how it impacts your qualifications. A low credit score doesn't mean you can't get a loan, but it's going to be more restrictive on the underwriting guidelines. I don't know about you guys, but if I have someone come through with a 780 credit score and very little debt on their credit report, we don't talk a whole heck of a lot about credit. It's like, cool, you're wonderful, and we're going to move on and get you the best terms. The conversations that we have, Nathan, you had mentioned 680 is an important threshold. It's for someone that has a 672. Can we get you a 680? It's for someone that's a 600. What do we need to do to get you up above a 640 so we can hopefully get that automated approval? Nathan, where do you start that conversation with a borrower that's below one of those thresholds that you're hoping to get to a higher level, and just discussing with them what their options are and what they should be doing?
We have to start by looking at credit and credit history, right? There's a lot of factors that go into it. It's not just simply what's your score, right? Credit histories matter. How long have you had credit? What appears on your credit? When we're working with the people that have, like, say, 672, right? I always talk to our clients. This is more towards like conventional or FHA loans, but it does kind of apply to VA as well, right? Every 20 points matters, and those 20 those numbers are hard stops, right? If you have a 679, you are getting lower tier pricing than you would if you have a 680. 680, you're going to be in a better tier. You're going to have a better price. And there's a lot of factors, right? We look at how long have you had credit? What are the balances of your credit accounts? How many, have you made your payments on time? What's the mix of your credit? Oftentimes we've had clients where, the good thing is we have these simulators that we can use. Now, they're not exact sciences, but if I have a client that has 3 credit cards and 2 of them are at a zero balance, one of them has a $1,000 limit and they have a $900 balance, right? That high balance is what's hurting their credit, right? Typically the credit simulator will tell us that, and we can look at it and be like, hey, you got $300, awesome, pay this down by $300, you're going to get 4 points on your credit. Right, we have the ability, and depending on the client's timeline, would be how we would handle it. Right, this is one of the other reasons why we tell people, hey, as soon as you have the thought in your head that you're going to buy a house, you need to go go through the loan approval process. Right, you want to do that as early, because if I got a client that's buying, hey, you know what, we're going to PCS, and I know that this station, we're going to be here for 1 more year, but I know that we're going to PCS somewhere else afterwards. That's the time to get pre-approved, because if you do have that credit issue, instead of having, hey, you need to pay this down right now, and I need to order a rapid rescore, and, we have to go through this kind of just urgent, drop everything and get it taken care of right now. That's stressful, and it's not the way we want to take care of it. But if we know, hey, you know what, we got, within the next couple months, I need you to pay this balance down to under 50%. Right, we all know those kind of thresholds for balances, right? If you're over 50% of your available balance, it's hurting your credit every single month. You're getting dinged for that, right? You get under 50%, it stops hurting your credit. You get under 30%, it starts helping your credit.
Let's talk about a couple of things. I mean, you brought up a bunch of really important points there. You've looked at the borrower's credit report. We've seen the score is suboptimal in terms of getting them the best terms. And now you've dug into that credit report and starting to analyze what can we change. Would you say that's probably the most manipulatable, for lack of a better word, is that credit utilization is probably the easiest thing. It's very hard to get rid of an accurate late on a credit report, but
Correct.
updating a balance on a credit report just involves having the money available.
Right.
Some things are just time related, right? If you have a late from 6 months ago, and it's a valid late, we can't do anything about that. A time is the only thing that's going to heal that damage, right? And when we talk about what hurts your credit or what affects, man, late payments, they can crush your score. One late payment on one account. I mean, I've had clients that have had a $25 payment that they missed because they switched a bank account, or they moved and they didn't get the notice, and they didn't, there's so many little reasons. But those late payments, I could just tell, like, for everybody that's watching this, that right there, you want to talk about a credit killer? Late payments will kill your credit. And we can't do anything about it because for 24 months, those hurt you. They're there, and they can't. The further out they are, the less they hurt. But yeah, like you were saying, we can't do anything about that. Credit balances, we can do something. Mixture of credit, like how much credit you've had. I know, I don't know if we're going to talk about this, but authorized user, right? If you have a friend or family member that has a well-established, good credit account, that they can, a high limit, low balance with 5 years or more of history, you get added as an authorized user for that account. It can be a huge boost to your score to offset maybe another card that you have that has a high balance if you can't afford to maybe pay that balance down.
Well, let's work through all of those things, because again, you brought up a bunch of valid points. So on the topic of credit utilization, you mentioned, hey, if we can get it down to 50% of the limit, but if you look, there's a bunch of tiers. 50 is important. The rule of thumb that the credit bureaus will tell you is 30% to get the most bang for your buck on your score. But we also know inflation is high, cost of living is high. People are not able to manage that in the way that they have been in the past. So Michael, what do you see is really punitive, where you start seeing that credit utilization have a big impact on someone's score? So if we can get it under 50, that's great, but is over 70 bad? Is it over 90%? Where does it start getting someone a big hit to their score?
Well, from what I've seen over the years is, what I tell people is, you could have great payment history for decades, right? But if your credit balances are a high utilization compared to your limit, like, you're gonna have bad credit scores. So I honestly don't know the exact exact limit that the credit bureaus are using, because we have three credit bureaus. But what the rule of thumb I've been told is under 10%. Not zero, don't pay it off, but under 10% utilization is kind of ideal. But under 50 is great, under 30 is better, and under 10 maybe is a little bit better than under 30.
Well, I had a quote here, and somehow I lost it. I meant to save it for the show. But one of the executives at FICO said when they have examined borrowers with 800 credit scores, the average credit utilization is 7%. So that's anecdotal, but that's people who've achieved an 800 plus credit score are, like you said, under 10%. And a paradox there is some people think, well, if 7% is good, 0% is better, right? Brian, you want to talk about why having zero balances is also a negative, maybe not as bad as having a 90% or 102% credit utilization, but why is a 0% negative?
Right. Yeah, I think anybody that's carrying any debt, it's like a weight up here, right? It's like on your shoulders, and you're always thinking, I need to pay this off. I need to get it up to speed. Well, I can't tell you how many times I'll be working with somebody that's getting pre-approved, and they'll say, hey, I'm going to pay all my accounts off, run my credit afterwards. Well, hold on a second. Hold on. Let's not do anything yet. Let's see where the credit report is now, because a couple of things here. One, it's going to take 30 days for that to post until the next cycle. If they're in a hurry, or if they want to see what's going on with their credit, then let's get things going now before you need to pay them off. Second thing is that if you pay those accounts all the way down, it could actually hurt your score, and which seems kind of counterintuitive. But the reason why is because they're measuring your ability to borrow money and pay it back, borrow, pay it back. And they want to see utilization on there going back and forth where you borrow, but not overutilization and not underutilization. So it's kind of like a scorecard. They're rating you every time you borrow money and you make a payment. And if you keep it, like Michael was saying, in that sweet spot under 10%, 30% is always a great rule of thumb. But yeah, if you go down to 0, it can actually drop your score, because I mean, that could be like a one-time gift where somebody pays it off and then they're going to slowly rack it up again, right? They don't like that when you do that. So,
and going back to Michael's point, we don't have a chart that says, hey, if you get to 94%, it's going to take 12 points off your credit score. But I can probably speak for the three of you. We've all seen a credit report where a borrower has a perfect credit history, never missed a payment, no collections, no judgments, nothing negative on there, but they've got 5, 6, 7 maxed cards at 90, 95, or 102%. Like the biggest thing that I've seen someone with otherwise perfect credit and they have this one card and is 1% over the limit, and it have a 50, 60 point hit to your score. And the reason why, it's kind of, I think this is a good part of this conversation, is giving you guys at home a chance to understand why. What is the credit bureau's thinking of that? If you have multiple maxed credit cards, it says, hey, you're borrowing at the limits of what your creditors have given you. And if you also then layer inquiries on top of that, you have 4 maxed credit cards and you inquired with 4 other cards that you'd like to get another card, it's looking at that and going, hey, this is a person who's losing control of their ability to repay their debts and looking for access to more credit. So all of those things kind of layer in there. So I think we've covered the credit utilization pretty well, but you want to have it above 0% and close to that 0 to 10% as possible. 30% would be next best, 50% would be next best. Once you start getting above 70% credit utilization, you're going to start see some negative impacts on your credit score, even if you have perfect credit otherwise. So with that, why don't we jump into sort of the big ones that will have a negative impact, and also paradoxically some different things opposite to conventional wisdom of what you should do if you have them. I'm talking about collections and charge-offs. Nathan, you want to walk us through the difference? What is a collection, and when it becomes a charge-off, how is that different than a collection?
Well, essentially, a collection is an account that you haven't been paying on, and the original creditor takes that debt, and to get it off their books, they sell it to a collection company. Some of them will actually have collection departments, but essentially what they do is they basically notify the credit bureau saying, hey, this person is not making their payments as they've agreed to make them. And typically it's usually after, it really depends on the creditor, right? I've seen on hardcore cases, I've seen them go as early as 90 days. Most creditors, I think, go out to about 120, 180 before they send it over to a collection. But a collection is basically an active debt that basically they close your account, they send it over to a collection company, and then that collection company attempts to collect that debt from you. But it's no longer, the account is no longer open, and it's no longer held by the original creditor. So if you have unfortunately, this is the one I think we see the most common, is like cable, right? I don't know, see Comcast or Xfinity, whatever, on so many where you move, you didn't properly close your account down or whatever, and they sent the bill, and they just kept sending that bill to your old address. And the new people that moved in didn't, never forwarded it to you and didn't take care of it. So it goes over, Comcast basically sends it to one of the, multiple collection agencies out there. And they report to the credit bureau that, hey, this account is, Comcast closes that account. And then the collection company registers that account with the credit bureau saying, hey, this is now an active collection that we're working.
So Michael, tell me this. I know we've all had this one too. It's funny when you guys are talking, I know we've all had this, the same scenario. You have a client come in, they tell you they have perfect credit, you pull the credit, and they do, and boom, there's the Comcast collection on there. What happens at that point? What does that borrower always want to do, and what is your advice when you have that come up?
Well, it's not just that; it's also medical collections, and a lot of those are items that they don't even know about, like they're not aware. Like I just canceled my own Spectrum And I wasn't, I don't remember that I had a box I had to return. It was like $60, until I called them and said, hey, I still got a bill, They said, oh, you got to return the box to UPS and do this. So some people don't even notice that, and they get a collection. And the most I've seen, the worst I've seen are very small items, for like cable and medical collections. And the cable is you didn't return your bill, or maybe, for example, you canceled your service and you weren't sure that the last bill was, prorated and you still owe like $50, or medical, like you went to your doctor and they didn't charge the insurance company properly. And, it's a very small amount. So what a lot of people want to do is just pay it off. Right. And if that's a very recent item, paying it off, like if it happened last month, you pay it off, probably no difference, to be honest. But if it was a little bit older and you pay it off, that just kind of resets the clock. And instead of like an older item that's kind of going to fall off it, maybe at some point it kind of resets it. So it just kind of affects your credit right away. So not the best idea to pay off a collection, because you may want to try and negotiate, get it removed completely, because like Nate said, those are companies that you owe money to, and they kind of gave up on collecting the money, so they sold it off, most likely for pennies on the dollar, right? So they would much rather get paid in full, and if you negotiate, you talk to them, they would remove it from your credit report if you pay them off. It's kind of a it's like a, I don't know if it's like a blackmail or whatever you call it, but it's they're kind of holding you hostage for it. But they don't care about reporting to your credit. They just want their money. So most people with collections, the creditors don't get paid on it. That's why you have $1,000 you owe. They buy it for like $50. So they're okay taking a loss. But if you paid them the full $1,000 and they only bought the debt for $50, like, sure, they'll clear your credit for that. That's a no-brainer for those guys.
It's a very important distinction that you made there. So pay for deletion. If you call on that collection and they say, yeah, cough up the full $1,000 and we will delete it, that one, feel free, do that 8 days a week, pay them, get it deleted, because it's going to come off, and we'll circle back and talk about rapid rescoring. But within about a week, we can get your credit score updated. But the deletion is important. The other piece, every collection has a date of last activity. And if that collection was 5 years ago, it sits there and it looks like, okay, this person had a negative event 5 years ago and nothing since then. And it's having a minimal impact to your credit score. If you pay it off, now we have a paid collection with the date of last activity being last month. And it looks like there was collection activity as recently as last month. So it's counterintuitive, but it absolutely can have a negative impact on your score in the short run. The timing of all this stuff, it doesn't really impact us. Let's say, the only way we would know is if that person, their credit report expired. So let's say we run their credit and they go and pay the collection off tomorrow. And if you were to run it again, that might cause the score to drop. But again, for us, those credit reports are good for 90 to 120 days, depending on the lender that you're working with. So we don't necessarily have to pull it, but we're also talking about what are the things that we can do to improve the scores. Brian, what is the difference between a collection and a charge-off? And is there any difference from a lender's perspective of how they're looking at it when they see one of those negative items on someone's credit?
Right. Well, a collection is a debt that creditors actively trying to pursue repayment of, and then a charge-off is one. I think this kind of got kicked around earlier, but that the creditors already sold it off. They've stopped trying to pursue that debt. Now, as far as the VA is concerned, on VA loans, collections don't always have to be paid off. If there's a minimum payment amount on there, then yeah, that's going to have to get factored in. That's going to be kind of on a case-by-case basis. But yeah, they don't always have to be paid off. But one thing I was going to bring up is I actually saw this. It was on a manual underwrite, and there were multiple collection accounts, and it was also a situation with where somebody had co-signed for somebody else as well, and a lot of derogatory stuff there. But it was going to be able to go through as a VA manual underwrite only after there were 12 months of satisfactory payments once those debts were brought current. So sometimes you don't have to pay them off. Sometimes they need to be addressed. And then you have to have 12 months of subsequent payments for them to be able to approve it for VA standards. So like Nathan brought this up earlier, if somebody's looking at potentially buying within the first year and you haven't taken a look at your credit in some time, it's so important to get that credit report early so that if there's items that need to be addressed like that are going to take a substantial amount of time, then you can go and start chipping away at that stuff. That's going to be the risk versus gain there. The gain that you would get from having that time to work on that as opposed to the risk of doing a credit report now and maybe another one in 4 or 5 months whenever you finally find the house, then where it has a couple points hit to your score. I mean, it's not as big of a deal there. So anyways, kind of got off topic there, but yeah.
No, not at all. And we actually have a couple of good questions that kind of piggyback off of what you just said. Mike Alberico, who was one of our guests last week, another vetted pro, says, what is the best place to get an accurate score since there's different score models and a lot of sites don't use the mortgage credit score? Like Brian, you were just talking about, get with your mortgage professional. They'll pull the credit and you have a real mortgage credit report. A lot of people don't want to do that. They kind of want to lone wolf it, do it on their own, which doing it on your own is better than not doing it at all. But what do you guys recommend to someone who wants to see a score and a report without coming to you for a full mortgage credit report?
Go to the Go Bag, Vetted VA Go Bag. You can get an idea of it's an estimate, but so that's an area you can check out. It'll give you an idea of what your score is going to be. But again, there's nothing quite like that mortgage hard pull 3-score report. But another option is some lenders, they'll do what's called a soft pull, and a soft pull, well, it's not a hard inquiry, but it'll give a fairly accurate representation of what your score is going to be. And sometimes that's with all 3 bureaus. Sometimes it's only with 1 or 2. So that's also another option. But I'm curious what
the main problem is. There is no substitute for the credit report that we pull. There isn't. There's not the Vetted VA Go Bag doesn't do it. Their Experian. I mean, Vetted VA Go Bag, awesome. It's a great tool. It's great for monitoring and managing your credit, I think. But if you need to know what we are going to go off of for your approval, you have to fill out a loan application. You have to go through the process of applying. And I know a lot of people they're like, I don't want to do that. Well, here's the reality is you have to. I mean, otherwise all you're doing is guessing. The mortgage guy you're working with, they're guessing. They're making the best guess they can. But without the application, we don't know. We don't know what we have to look at all 3 bureaus, right? Because we all seen it, right? Where you've done a soft pull and you pulled Experian soft pull and you looked at the credit. Hey, yeah, everything looks good. I got a 692 credit here. And then you go do a hard pull. Well, TransUnion had 2 collection accounts that weren't reporting on that Experian account, right? Because certain collection bureaus don't report to all 3, or collection companies don't report to all 3 bureaus. And the reality is when you talk to Sam and you talk to some of our credit experts, right, Jesse and these guys, a credit pull, like everyone's so usually super worried about it, right? Oh, I don't want you to check my credit. I don't want you to check my credit. How many points are you going to lose? If you have really bad credit,
very minimal. Yeah,
exactly. You're going to lose at the most I've ever seen is like 7 points.
That's a lot.
and that was okay, cool. But if 7 points makes the difference, it's going to take more time. You know what I mean? We need that time to fix the credit. We need as much time as we can. Like Brian said, we need to start as early as possible. So it's not a big fire drill to get everything done. We know we have time to take care of things, right? You got collections. We need to negotiate with these collection agencies. Well, if you apply today and you're trying to buy a house this month, the collection agency has control, right? They have the power on that negotiation. But I did a loan actually for a guy who worked at a collection agency one time, and he enlightened me. Hey, you want to pay off? You want to negotiate with a collection agency? You know when the best time to call? End of the month. Those guys
are they on the quota also?
Guys are sales guys with quotas, and guess what? At the end of the month, that guy needs $70 to hit his numbers. He's going to take that $500 thing and be like, "You got $70? Pay it. Let's go." I mean, it's the truth. It's how it works. But if you wait too long to go through the process, You don't have that luxury of waiting until the end of this month to call your collection agency. You got to go now. So if you start today and we're not buying till March, man, we got time. We got time, and we can work.
What I tell people is your credit score is kind of an evolving thing. Like, you don't have a credit score, right? You have a credit profile, and that's going to change. Like, it's like your blood pressure. I'm getting up there in age, and it changes every day. So your credit score is going to change, right? But really, your profile is what matters. So I don't really focus on the score, because I've seen people with decent scores, but that kind of maybe gamed the system, and they still got through everything and got what they wanted. But I've seen people with lower scores but better profiles still get through. So, I kind of refer people to, there's a free site sponsored by the credit bureaus, annualcreditreport.com. And right now, because of COVID, you can get, I think, daily, just like the Go Bag, you can get like daily updates on your credit profile, right? So just like your health, right? Like, as long as everything's working, everything's moving forward, and you got things handled, like, your score is going to be fine, right? Just like your health, like, you're doing what you got to do. You're doing everything you're supposed to do with your health, eating right and everything. Like, the end result's going to be okay. So, I don't focus on score, right? It's like you get a test score, but you don't know what you learned in the class. Doesn't really matter. So I like to focus on not the score itself, but what builds into it. Like, if your profile's fine, your payment history, your like we talked about, your utilization of credit, your collections and charge-offs, whatever, are under control. Like, if that's all fine, like, your scores are going to do just great, especially for VA, which is the most lenient of all the loan products. So maybe FHA, possibly. At USDA, I'm not really an expert on at all. I don't even do those. Rarely FHA, actually, but conventional, 720 to 700, big difference. VA 720 to 680, like, you probably won't see a major difference, because the underlying details, the underlying health of your credit is essentially the same. Very little difference. One eats more broccoli than the other, but really, no major changes.
Yeah, I've seen some where it was the same pricing from 680 all the way up, and sometimes it's every 20 points. So,
right. Well, it's the investors. The investors change their appetite, and their, they change what's, their risk models. But you're not going to see a huge difference in VA. A little bit, a few dollars, but it's not like conventional, where, like, a conventional loan, you put down 5% or 10%. And if your credit scores are a different tier, like even 20 points, like, not only is your mortgage going to be different pricing, but your mortgage insurance, which you don't have for VA, is going to be a huge difference, from anywhere. It could be from like between $50 and like $250. And that's only like a 40-point difference. But, and that's just the mortgage insurance alone, not even factoring the mortgage, the interest rate. But VA, it could be dollars, right? Which is amazing. That's why I love working with veterans and VA loans, is because there aren't the penalties involved with the minor credit differences.
One of the things that you said there that really stood out is you don't have a credit score. People tell you ask someone their credit score, they don't know, for the reason that their credit score is a snapshot of a moment in time. That
Right.
second, when we pull it, your credit file changes every day. The best example I have is my personal credit report. I had a surgery a couple of years ago, right the month before we were getting ready to do our refinance back during COVID in 2020, when rates were super low. I have a credit card with a $12,000 limit on it. I put like $11,000 on it for the surgery to get miles. So that thing's up over 90%. And we pulled the credit report to do the mortgage, and the score was like 80 points lower. That's can have that level of difference. I about choked, and I looked at it and I go, oh yeah, I forgot that we did that. So we went, paid it off, sent it in, did a rapid rescore, and later on that week, it went right back to where it was. But just the point being is it is really that moment in time of what is in your file. The credit scoring model is just a computer algorithm that's running on whatever your creditors are reporting on that day. So if you use your cards through the month and then pay them off, use them through the month and pay them off, however you used them on that day that it's pulled is the report that they're giving. We've got a couple of other good questions here. One of our viewers says, are credit repair companies legit? Do you guys use credit repair companies? And can they be beneficial? Are they necessary for people looking to improve their scores?
Okay.
Michael, you about to spit your
we maybe we had to spit up his drink.
Well, I mean, in general, I think most of them are just junk, and that's just my experience being in this business for a long time. There are companies that will take monthly fees and they'll say they're going to help, but all they're going to do on a monthly basis is write letters contesting the debt to the creditors saying, please show us blah, 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 right? It's just crap, and the companies will reply or not. I don't even know the laws, to be honest, about those, but they don't really do much. And it's just like a grind. And those companies, from my opinion, just like to get the monthly, collection from these people that want to improve their credit, like $100, $80, whatever it is, some of them have company names that, are ex-presidents' names. I'm not going to mention any names, but I know there are companies, and I know a lot of us work with My Credit Guy. And what I like about them is they talk to the clients and they give them like the honest assessment, like, hey, like this is a legit debt. Like we can try and contest it or work with them, but most likely, like, you messed up, like I tell people the hard truth, like you had a mistake, like you did something wrong. You skipped your bill. Like, sure. Like you may not get it off. So a lot of the credit repair is just junk, like, I mean, I think credit repair is, for the most part, you make a mistake. Like if it's right away, maybe you can clear it quickly. Like if it's not a mistake with a goodwill adjustment, talk to the credit company, make a few phone calls. You don't get the right answer, make a few other calls, talk to someone else. Maybe they'll reverse a late payment, and that's, maybe there's more than that from my experience, but that's like the best you can get. If it's an older debt, the best you can hope for is the company doesn't reply, and that's just like a shot in the dark. So that's just my opinion. But I know My Credit Guy and there are a few other companies, they will tell you like, hey, maybe, or this is your chance of getting it done. And, but if it's a real credit, like legal issue, like, you may want to get an attorney for that, but then you're going to pay a lot of money and maybe it's not worth it. But, I think a lot of that is junk, and maybe you'll get a little bit of results, but really it's just, the hard truth is like people mess up, like, like you're right. And so you got to just, get back on track and just, eventually your body will forgive you. And, like the credit's like health, like you just treat it right and it'll do right. You make a mistake, it'll repair. You just gotta do the right thing.
Well, tell me if this jives with what you guys see with your clients. Most of my clients who we can have a big impact on their score, it's one or two items, kind of like my situation. Like I can look at it and go, oh, why did you max that one credit card out last month? Well, we had a big vacation and we spent everything. Oh, cool. Are you going to pay it off? Well, no, but I could pay it down $4,000. You don't need a credit repair company for that. The four of us see enough credit that I can advise you on what's going to have a big impact in the short run. The folks that I have sent over to My Credit Guy are somewhere you look and there's 23 items on there that need some attention and work. And the benefit,
duplicates,
things, and what it boils down to is They're professionals that do this every day. Like Michael said, there's not magic. They're not, one of these companies is just going to bombard with the letters disputing the accuracy, and it gets removed temporarily and then gets put back in there. What they're going to do is they're going to work on it for you. They're going to work on pay for deletion. And then if they won't delete, okay, well, how little will you take to pay off this collection? Advising you on adding a secured credit card or getting an authorized user to balance that. And they're working on it full time. That person that has 20 something things on their credit report, you can fix it. But if you want to fix it in 60 days, you're going to be spending a couple hours a day working on it, and that's paying someone to do that work for you. There's no magic that you couldn't do yourself. It's just like mowing your lawn. Do you want to do it, or do you want to have a gardener do it?
Credit repair takes two things: time and money. The money is only going to come from one place, and that's you, the person who needs to fix your credit. The time is what you pay my credit guy for. The time and the expertise. It's kind of like the same thing. It's like, why do you go to a mortgage broker to do mortgages? Because we know what we're doing. It's the same thing to me with credit. Now, Mike's right. I would say 98% of them are snake oil salesmen in my experience. But there are some good ones. My credit guy is one of them, where I think I've had my credit guy actually send more clients back to me saying, hey, these guys don't need us, which I've never had from any other credit repair company out there, where they've literally said, hey, this guy doesn't need us. Here you go. Here's what you need to do. Get this stuff taken care of. But you're right. It's the guy that has the 20, the 15, all these multiple accounts. But it all boils down to the same thing. It's time and money. It's going to be your money. But is it going to be your time as well? And honestly, like I feel like most of my clients that end up going to credit repair, that's why. It's like, hey, I don't have the time and energy, because you're right. It's a 2-hour phone call getting passed around from manager to manager to whatever till you get to the right person. And that's where the expertise of a credit repair agency that you can trust comes in, because they do know how to make the calls. They do know how to negotiate. They do know how they will write the letters for you. Can you do it all on your own? Absolutely. But it's a full-time, like the people that do it there, it's a full-time job. Yeah. Do you want to do a second full-time job?
And I would say I'll warn my clients who are considering it, is this is like going to a personal trainer or a nutritionist. It's not magic. You don't write them the check and it happens. If you're not going to go to the gym and do the work, if you're not going to put down the fork, nothing is going to change. And I am stunned at the people that I have, like, no, I got to get this done. I got to buy a house. They sign up. 8 months later, they're still paying. And you look and they haven't paid anything off, and they owe more on their credit cards, because we get a report every month of the progress you're making. So you can see the people that are chipping away at it and working. And we went from a 580 and we're at a 622, and we're like, cool, we're like 60 days away. You're going to have a 640 and we can do something really good for you. Then you see the other person, you're like, your scores are worse than they were 8 months ago. What are you actually doing? And why are you paying someone if you're not going to take their advice? But again, it's like the gym or the personal trainer. People will pay because they feel like they're working on something, even when they're not doing it. So hopefully that was a good answer on whether credit repair companies. You have something else, Brian?
Yeah, I would just say that don't focus on cost with that either, because more expensive doesn't necessarily mean better, but just cheap does not necessarily mean good. I've seen plenty of people that have been kind of sucked into like what Michael and Nathan were talking about. But some of those companies out there, I call it, they were looking for long-term subscribers, and that's not a place that you're going to want to be in. Their monthly payment's going to be low enough to where it's something where you're just going to leave it on auto payment, essentially. Yeah. So
there's a particular law firm out there that everybody should be wary of.
Yes.
Yeah. Most legit law firms don't have a call center.
Yeah. Anything with a subscription, just be wary of, to be honest.
So we've got another good question here, and this will lead me into kind of the next topic I wanted to talk about. So Brenda Kemp says, how long does it take for a payment to show on an account? I paid off an account 3 months ago and the dollar amount still showing on the credit report. Is that common? Do you guys see that? Someone pays off an account and we don't know. Brenda, if you're still here and you want to make
what type of account?
Was it a collection? Was it a credit card? Was it, an installment debt? Because that can make a difference. But have you guys seen this? I had one recently, same situation. The gentleman paid off a fairly large installment debt, and 60 days later they still hadn't reported it, and they're like, oh, it has to go through the next billing cycle. And we're like, 60 days, we should have been through 2 billing cycles at this point.
I think with installments, or one thing in, collections and charge-offs, they don't care about reporting properly. Revolving debt, credit cards, they're going to report on a regular basis because they have to, because they're going to generate the next monthly bill. Installments, they probably should more than anything else. But if it's a charge-off or collection, I mean, they're going to take their sweet time to report to the bureaus because it's just extra manpower for them to just, whatever. I don't even know what it takes for them. Click a button. Is it a paper report? Is it a Scantron? I don't know.
The dreaded timeshare.
There's a timeshare, yeah.
Yeah.
I mean, it's like collection agency, timeshare. They're pretty close to each other.
A couple of things too, though, is that I would also ask Brenda what she's using to see that it's still reporting, right? Because if it's showing up on like Credit Karma or something, take it with a grain of salt. If it's showing up on your lender's inquiry on their reports, then they could do what's called a supplemental credit report, where they should be able to do a joint phone call with the credit reporting company and make sure that that's updated, showing that it's paid off, and have it removed from at least from your profile for the purposes of a loan.
I would also ask, what does your balance, like, do you receive balance statements, like monthly statements with your balance? If you receive that and that's reporting a different amount than what's showing up on the bureau, then that's when what Brian said, you would go with the supplement. And I just got to follow up on Credit Karma. Man, there's your bank or your credit card company. They offer credit monitoring service. You can go directly to Experian, Equifax, TransUnion. They all offer credit monitoring services. Credit Karma is a lead aggregator. They do not care about accuracy. They do not care about the info they provide you. They care about selling your information. So everyone on here, cancel Credit Karma.
Let's be real. I mean, they're a marketing company, right? We can all agree that that's what they do. They have your data. They collect a monthly fee. Maybe they have a free service. I don't care. But they're just trying to find out your service, your habits and everything. But
if you work with your creditors that you already have, you've already signed every credit agreement that you have with every credit card you have. You've signed an agreement that allows them to do soft pulls on your account. Like, they can check your credit anytime they want to without a hard inquiry. You've already given them that access. So use the free service that they're offering you, because they're doing it anyway. All you're doing is having them send you the report that they're pulling.
And also the credit bureaus themselves, the three majors. And what I found out very recently when I signed up for a privacy service, Enovis, is it? Hold on, what is it? It's sorry, I don't have my glasses on. I can't see, but Enovis. So that's the fourth major credit bureau. They are all marketing companies, is what they are. Like, they collect and sell your data, right? Yeah. So, I mean, all of us here on this call, we know that we tell our clients up front, like, hey, I tell them up front, like, even now, like, I'm going to run your credit, but I want you to sign up for this privacy protection first. I'll do a soft pull so no one's going to bug you, and I won't run your credit for like a week to make sure that you're not in the system of solicitations from who knows what, who knows where, from whatever what, right?
Michael, why don't we use that sort of to follow up with a thing? If we have a little bit of time, if you have a couple of days, the client can go to opt out pre-screen and opt out of pre-screened credit offers. Do you want to explain what a pre-screened credit offer is and why you would like to opt out of them if one of us is going to, or any other mortgage lender is going to pull your credit?
Well, opt out pre-screen, from my understanding, is they work with credit. Mortgage companies for credit pulls. They work, they check out when you pull your credit for car loans and insurance company pulls, and they give you quote unquote pre-approved offers based on your credit profile. And they check it against other data and they sell that. Like, people can sign up with the credit bureaus and buy your information. Like, they don't buy your credit, your social security numbers, but they get like, hey, Joe Smith ran his credit for a mortgage. And Joe Smith, because we're in 2022 and your data is all over the world, they can get your phone number, your address. They can find out who lives with you, and you name it. Like, your data is there. You went on some websites 10 years ago. It's propagated. And based on your credit profile, they say, oh, you're technically pre-approved for this offer. whether it's a credit card or a mortgage, whether it's legit or not, who really knows, but that information is sold by the credit bureaus. And it's terrible that we rely on the bureaus to generate these scores, but they're also for-profit private companies, which I think is terrible. That's my own opinion. And there's no protections right now, right? I believe I guess the best word for it is our trade association, AIM, has not a pact, but I guess I don't know, what's the word? We have lawyers, I guess, a lobby group trying to change what's going on to prevent that, because a lot of it's not accurate. A lot of it's spam. There's no limitations. There are many people who, when they get their credit pulled, and if you're a veteran in the military, multiply that by 5 or 10. When you get your credit pulled for a mortgage, you're going to get everybody and their mother calling you for your business. And you don't know who they are, what they do, what their background is, and you're just going to have to change your phone number and move out of the country. And it's terrible. I mean, there's nothing we can do about it. That's why I tell everyone, and a lot of people have gotten wind to let their clients know, and that's why you shouldn't rush to buy a house. You should plan properly. So for me, a lot of my clients, I tell them up front, hey, you're not homeless tomorrow. Let's sign you up today, not just for optoutprescreen.com, but do not call.gov. Those are the two main ones. Thank you, Rico. And there are a few other services that don't really bug you too much, but they'll limit your email spam and your catalogs and all that junk you get in life that we shouldn't have to deal with as humans, right? Just to give us some privacy and protection so we know who we're working with and why. Because
I got a wild one here for you guys.
Sure.
A client of mine actually sent this, so I'm going to share this screen.
Oh my gosh, that's not.
This is what happens. This is what happens when you do not opt out of pre-screened offers. We pulled her credit, and she had completed the application the day before. So I get a text from her and says, "Hey, did you pull my credit?" I'm like, "Yeah, why?" She goes, "Because this." So look at that. I mean, it's 3:04 p.m., 2:40 p.m., 2 p.m., 1:49, 1:47, 1:27, 1:22, 1:14, 1:08, 1:01.
And those are all different companies. Those are all probably different companies.
And all they wanted to do was sell her a mortgage. And the worst,
what they're going to do is say, "Hey, I'm going to give you a better deal than your loan officer." They don't know what they're doing. And you look up these people, and fortunately, unlike other industries, when you're in the mortgage business, everyone here, all of us, we have a unique identifier. It's public information, and you can see from the public how long we've been licensed, who we've worked for. I've had a client, she was a Navy veteran. She's had medical issues, been undergoing chemotherapy for years since I've known her, right? Just not in the best health, family, she's a mom, she's got little kids. And she would get tons of calls, and she's not in the right mind space to really vet everything herself. And the last person she talked to was trying to, if I'm going too long, just play the music, walk off music. This really pisses me off, and sorry for my language, but I helped her refinance 2 years ago into in the twos, which a lot of people did. And she had very little debt, and they were trying to get her to do a cash out refinance, 90%, in the 6s, to pay off very little debt, which all it took was hey, make a spreadsheet and work out your debts and pay it off, But the person she talked to said, "I've been doing this for 20 years. And you look at their license, and they've been licensed for 6 months. And a lot of us have access to production data, which, accurate or not, is, at least in the ballpark. And from what I saw, this person had never done a VA loan ever. And I think, Josh, you mentioned that before earlier about something else. So this person, lied to this person, and veteran or not, about their experience, was giving serious financial advice, which could be a huge detriment, not to a person, but to an entire family and maybe a generation, right? And they had no idea what they're talking about. which is terrible. And a lot of it is because they didn't have any protections for getting their information shared, not having their privacy protected, which is as simple as going online, spending 2 minutes to sign up for a website. And not that pre-screen's only for 5 years, but you can spend another 5 minutes to print out a piece of paper and mail it in. And there's your lifetime protection against those pre-screened offers. And I'm good.
No, because Michael, that's no joke. When you were telling that story, I was like, I have the exact same client. It's funny. It kind of circles back to 2 of your stories. Guy here, I'm in Huntington Beach, California. We helped him buy a condo a few years ago, 68.9% debt to income ratio. We were able to help him do 3 different IRRRLs and just ride the rates down when they went, because he bought in 2018 when they were high. I believe we have him at 2 1/8 on a 30-year fixed. He gets a call. It gives me a call and says, I got an offer. I want to make sure you guys can beat it before I move ahead with this guy. I need $40,000, so we're going to do $40,000 cash out. He's not funding fee exempt, so he's going to pay a subsequent use cash out funding fee and go from 2 1/8 to 6 1/2 on a $400,000 mortgage to get $40,000. And like, he's not a dumb guy, but let's be realistic. All of our clients don't deal with numbers. They're not numbers people on a day-to-day basis. When I pencil it all out for him, he goes, well, that's insane. No one would do that. I'm like, well, you just called to ask me if I could match it and do it for you. Of course it's insane. So the opt-out pre-screen, the do not call stuff, all that stuff is really, really important. So we've been going for about an hour. I told you guys this is a big and broad topic. We could probably go for another hour. Before we shift to our second topic of the night to quickly cover the Service Member Civil Relief Act, anything else credit-wise that you guys think we haven't covered that you would like prospective veteran buyers and mortgage borrowers to know?
I would just want to reiterate, when I say if you think you have credit issues, you probably do, right? If you 9 out of 10 times when hey, what's your FICO score? Most people with, I hate to generalize this, but my borrowers with great credit are like, I'm at 760, 780, 790. My borrowers that have bad credit or have bad credit history or had something happen, whatever it may be, typically they don't know. And they don't know because they don't want to know. It's one of those, right? It's like the ostrich thing. It's like, if I don't see it, it's not that bad. But the reality is, if that's you, get with it, and you want to buy a home, get with a mortgage professional as soon as you can. Start the process like you want to buy next week, because that way you can get that roadmap of, hey, now we can look at the professionals can look at your credit and go, hey, you know what? It's going to take you about 8 months to get this to where you need to be, right? So if you think you have credit issues, you probably do. You probably really do know what you have. Get with somebody as soon as you can so you can start working on it now, because it's hundreds of thousands of dollars difference between a 620 FICO score and a 720 FICO score over the life of your VA purchases, right? You're going to purchase several homes probably. We're talking about a lot of money between bad credit and good credit.
We're not
I was going to say, probably all of us have stories of a client who came to us and started with low 6, high 500 credit score, and over time and working at it, worked their way up. I mean, it sounds like you're climbing a mountain, like that's Everest. I've got a 592 credit score. How am I going to get to 725? It happens. You have to do the work. Like you said, time and money and work and effort, but it happens.
I've been divorced. You want to know what that does for your credit?
Right? Shoot it to the moon, makes the FICO real high.
When a judge mandates that you sell a home and close accounts, I mean, you know what I mean? It's like, I've been there. Like, I've done it myself. I've been in the 500s. And in our industry, I could lose my license for that, right? We have to maintain good credit. And so I've been there. I've done the work to get out of that bad credit situation, right? And I mean, worked with the NMLS to be like, hey, this is what I'm doing to repair my credit, right? So like some of us have been there. It's not easy. It's hard. It takes time. So the sooner you get started, trust me, the better off you're going to be.
It's not even like we're doing anything magic, no. Not at all. Like, we're just telling people the solid advice. Like, a doctor's going to tell you, like, don't smoke cigarettes, don't eat Doritos for breakfast. Like, you know that. People know that, but people still just do whatever they want to do. Like, we're just there just saying the same thing over again. We're seeing the same things over and over again, but like Nathan said, like, people that know they have good credit, like, most of the time they have good credit. People that aren't sure usually have something going on, but maybe it's not a big deal. But there are, like you said, 90%, like 10% of the people think they're fine, but some of those people may have had issues, and maybe they just paid up a collection last month, like we talked about before, and think they're like, okay, I'm good. Like the boogeyman's gone. Like I fixed all the bad things. Like they think they're good, and you run their credit, and they're still like a 580. You know, so it's no guarantee. But there are a lot of professionals out there, and I use that term lightly. There's people who are authorized to do what we do, and it honestly is a low bar for a lot of companies to do what we do. But it's just a matter of, are they trying to get the deal done, or just trying to get you in the right position so you get not just the best deal, but set you up so that you're a successful homeowner and competitive as a home buyer. It's a big difference. Like, hey, can you qualify for a house, or can you actually compete to actually get that offer accepted? Because there's a big difference. I mean, there's a lot of, and this is definitely off topic, but yeah, I'm sure it's brought up in other talks. But I mean, it's a little better now. But putting zero down on a purchase, like for some sellers, there's misconceptions that's a weak offer. But combine that with not the best credit score, even though that all of us know that with a manual, you should be fine in many cases. There are some people that will push people into that situation when maybe it's an easy fix to get you in a better spot quickly to, be more successful and save a ton of money.
Absolutely.
I would also say that, like Nathan was bringing up, it's one of those things where it's kind of like ripping a Band-Aid off. Especially if you're having issues, rip it off early, see what you need to do, see if you can stomach the work that needs to be done, and address whatever needs to be addressed. I mean, I'm working with somebody that they were telling me on how their credit just recently got wrecked, and they were so worried. They think it's between low 6s and high 6s based on what Credit Karma was giving them. And I finally convinced her to let me go ahead and run the credit report. She's at 708. So she was in a much better place than she thought she was in. But it's you just never know until you actually run those numbers, and just address it as soon as you can.
I would back that 200%. And the paradox is, usually if someone tells me they have, it's good but not great, they're usually underestimating. It's a little bit higher. And the person that says it's okay, there's some things on there but it's not too bad, that's usually the 560 570 score. That's horrific, as people generally underestimate how good or how bad their score is. So I'd like to close that thought on credit as saying life happens. I can say over my life, from best to worst credit score, there's been 150-point variance. So it's not a scarlet letter of having a subpar score or a score less than where you want it to be. It's not permanent. Like we said, it's a snapshot in time. You can work on it, you can change it, you can improve it, and you're not always in control of a divorce, car accident, job loss, any number of things that could lead to a temporarily lower credit score. But let's make sure it's temporary. Let's work on it. Let's move forward. You get people and a team on your side, you can absolutely improve it. So one of the things we want to talk about before we close down here for the night is this.
I got to run, guys.
You got to bounce?
Yep.
All right. Thanks for joining us, Nathan. We appreciate it.
Later, bro.
So one of the things we want to talk about real quickly here is the Service Members Civil Relief Act. Most active duty know what it is. Some don't, but it allows service members to suspend or postpone certain civil obligations so they can devote their full attention to their military duties. Brian, you want to explain what that means in real world terms?
Sure. So it's basically when you're getting mobilized, activated, if you're in reserve status and you're getting mobilized for deployment, or if you are active duty and you're deploying or engaging in some sort of mobilization that prevents you from being able to manage your finances, your home finances and everything, is that this is a law that was passed in 2003 that it allows service members to essentially, if needed, to break certain contracts, to pause certain debts, and to potentially even get late payments and things taken care of, addressed if it occurred during that time.
And so the big things like you're in active duty and you get PCS to the other side of the country, and it's going to have a negative impact on you, you can break a lease, which wouldn't normally be something that's allowable. They can place limits on credit card interest. So the important thing to know is that there is relief out there. If you have financial obligations that are problematic because of your active duty status, reach out and see what your obligations on there. I mean, the list of the benefits: caps on interest rates, tax relief, temporary relief for mortgage payments, which we've all seen, temporary or termination of residential and automobile leases. So not just a residential lease, an automobile lease as well, protection from eviction and stays of judicial proceedings. So there's a number of things there that you as an active duty service member can benefit from if your active duty service is causing you a financial hardship. So just like your VA mortgage benefit, it's a benefit that you've earned and deserve. So if you find yourself in that situation, reach out, get the help that you've earned. Anything that either of you wanted to touch on, either with the SCRA or credit, before we wind it down?
Yeah, I mean, being active duty in the past and somebody that's been mobilized and stuff in the past, I personally never really used this a whole lot whenever I was, but at the same time, I wasn't responsible enough to own a house either at the time. But I mainly just was putting a pause on cell phone payments or breaking leases if needed. But I would say that there's a pretty substantial amount of case law with this, with the United States actually being the plaintiff against certain municipalities and states and companies where they are prosecuting, because there's certain instances. I forget which one it was, but I want to say it was if a creditor charges some sort of late fee and they're in violation of the SCRA, then that could be up to a year imprisonment for that person. So there's quite a bit of precedence out there to back this law up, but I personally haven't seen a whole lot of it being used in application. I'm not sure, Wolf, if you have, as far as in the mortgage realm, but this is going to be one of those things where if you got questions, I would highly encourage you to reach out to your local VSOs, your veteran service organizations. These are going to be your nonprofits that are wherever you live nearby, whether that's VFW, American Legion, or even your county veteran services office. They should have something set up as well. But I would inquire there if you've got a concern that something that in your credit profile is maybe being violated under this law.
Yeah, I mean, I don't have a lot of experience with that at all, but a lot of the information is public. Like, it's easy to research it. So, like with anything, whether you're military, civilian, just be educated about your rights. Just know where to find the information and just know who your trusted people are to help you out with it. Like, people aren't, not everyone's going to help you and hold your hand with everything. So you have some some self-responsibility to do your own research, whether with the law. I wouldn't expect people or companies to always do the right thing, regardless of what their obligation, legal or not, are. So, just stay on top of it. And, you may need some help to enforce it, but you got to know what your rights are. And that's really the bottom line, whether it's, SCRA or whether it's just regular and general credit items, things like that. Like collection companies may not follow the law either. So any of that stuff, you just stay on top of it. Just know you just know what's right and what's wrong. I mean, and know when you make a mistake, credit wise, you miss a payment. Sure. Just, if you know about it right away, you can maybe try and rectify it with a goodwill adjustment, but something in the past, you're trying to get things on track, like that's an uphill battle. But know that, hey, I did it, but let's move on. Let's do the best I can. I didn't make the best choices in the past, but moving forward, I can fix things and make sure that moving forward, we're going to do the right thing to the best of my abilities.
Absolutely. So, gentlemen, I appreciate you being here. Appreciate Nathan joining us earlier. For those of you that watched, most importantly, we're thankful for you watching and viewing. We touched on a bunch of topics here tonight that we've gone in depth on episodes before. We talked about the PCS process last week. That came up in the show tonight. Michael, you had brought up a topic that we had covered a couple of months ago, getting a VA offer accepted in a hot market. Even though the market's calmed down, we're still seeing veterans have issues with that. So we have a library of content that our VA expert moderators here have gone through and answered questions and gone through topics exhaustively, just like we have tonight. So if you're watching, go back and look at the previous episodes. You can find them on YouTube. You can find them in the Facebook group, and like and subscribe to the YouTube channel. There's putting a lot more content out. Vetted VA through Nathan and Christopher's efforts are making a lot more video where you can quickly absorb content that's going to help improve your financial future through mortgage and related real estate topics. So again, appreciate you guys for viewing. Come back next week and we'll go through another topic of interest. Thanks a lot.
This guy.